Why don't you just not rebalance the portfolio? Just leave it like that. Suppose we go to this period of 2020 where the 2020 COVID crisis happened. A rebalanced portfolio should have done well because we will not be so much allocated to equity. Now, in this case, I kept it a equal weighted portfolio and this meets with my portfolio objective, especially on the dates of the rebalance. Have you ever opened your investment app and see a prompt that says, hey, it is time to rebalance your portfolio? Or have you ever wondered what they mean when you hear in the news headlines that today such and such index is going to get rebalanced? Today we're going to break this down. We're going to understand what rebalancing is, why it is important, and we're also going to understand how to implement it using Python on real data, actual data. So you stay with me as I take you through this entire process. The first thing we need to do before we actually get into Python is we need to start with an illustrative example of a 60-40 traditional portfolio. Let us first understand what portfolio rebalancing is. It is a very fundamental concept in quantitative portfolio management. And when you rebalance your portfolio, it gives you a lot of advantage. We're going to discover that. Let us first understand what portfolio rebalancing is. Imagine yourself to be an individual who has just started their career, has started working and making some money, and within the first 2 years or so, like many of you watching these videos, and wisely invest your money. So you decide to put your money in different assets in different proportions. Now, when you start putting your money, some in shares, some in mutual funds, in some form of gold, perhaps some bonds, what you end up doing is you start creating a mix. Our professional portfolio managers, they have a very well-defined allocation in terms of what proportion they want to expose themselves in which asset. But as an individual also, because you already have a portfolio now, you vaguely may want to have some mix or some proportion which seems quite balanced. What happens then? In the next few years, that is, over these market cycles, over these different phases of the market, some of these assets grow a lot. Some remain stagnant, some may even fall. So in a nutshell, they drift away from their original proportions. Now with quantitative portfolio managers who are very precise about maintaining these proportions, they come to a point where they want to now rebalance their portfolio. They want to adjust these proportions back to their target. This happens when some assets have grown way out of proportion or even not so much out of proportion, but at least drifted away from the target mix. And this kind of deviates from the initial investment. So what you want to do is you want to get this back into the correct proportions. In a nutshell, this is called rebalancing your portfolio. Now, why is this rebalancing important? It is important because number one, the markets are always moving. There will be some assets over a period of time then drift away from their original proportion. The more exposed you are to a particular asset or an asset class, you're taking more risk. So if you have a portfolio with equities, gold, and bond, and equities double in prices where the rest of them remain little stagnant, you actually increase your risk exposure to equities as well. So rebalancing helps you rebalance your risk exposure as well. And it also helps you maintain your original strategy with your original portfolio object. Rebalancing also helps you avoid emotional investing. One thing I've noticed in my career is that a lot of people, especially the beginners, they become very emotional. They become emotional because, let's say, they are lucky to find themselves in one or two stocks which have skyrocketed and giving them a multi-bagger return. Now it becomes difficult for them to actually decide whether I should keep letting it go up because I'm anyway in profits, or if I should trim down my positions, or I should sell out and buy something else. So they tend to get overly attached to these positions. And let's say you're in a situation where a particular sector, a particular stock has suddenly risen so much. For example, tech stocks suddenly rose so much in one or two booms. What you actually did to your portfolio is that without doing the rebalancing, you have exposed yourself a lot when it comes to the risk associated.
with tech stocks. So what you do is you rebalance. You trim down your position with those tech stocks and you get them back to their original proportions. While you sell some tech stocks, you will buy in the stocks which have lost their original proportion or below them original proportion, and this will give you a more rule-based approach to do things. With portfolio rebalancing, in many cases, you'll see yourself buying low and selling high. Now, this is not the most mathematical thing I'm telling you, but most definitely you will see many cases when the proportions have actually gone far beyond what their original proportion was for an asset. Obviously, you have to trim it down, and therefore you're essentially selling at a higher price. And vice versa for buying the stocks which have gone below their original proportions. So this is something which you do as a part of your rule without actually trying to time the market at all. Now, in the next section, we're going to take a small Excel example and go through the Python implementation for portfolio rebalancing. So stay with me, focus, keep everything aside, and just focus on what is being taught. And then once we have completed the entire framework, I'll show you some very interesting inferences and examples on real data. And these are real insights. So enjoy yourself.
So here I have a yearly frequency data for SR and TLT. These are the Y Finance ticker names for two ETFs. The SPY stands for the ETF, which represents S&P 500. So that is for equity. And TLT represents bonds. So what we are going to do is we are going to use these prices and understand how a 60-40 allocation, 60% to S&P and 40% to bonds. How the 60-40 allocation of a traditional portfolio tends to work over a period of time. Suppose we start in 2019. So our portfolio value is $100,000 at the very start. Using this $100,000, I want to allocate $60,000 to SPY and $40,000 to TLT. Now, in the beginning of 2019, and here we are not even talking about rebalancing, we are just talking about going and purchasing these units with our initial capital. So what happens is that the number of units I own for this portfolio which I want to buy and hold for a long period of time are fixed at the very beginning. So now that I've understood that these are the units I need to actually purchase and hold, I see how the prices have fluctuated over the forthcoming years. Now, as prices have fluctuated, the value of my allocation for both SPY as well as TLT has also fluctuated. And incidentally over here, since SPY has gone from 226.72 to 584, my SPY allocation, which begins at $60,000, becomes $154,637. Similarly, my TLT allocation, which was $40,000 in the beginning, actually becomes $33,433. So it has fallen a little bit. Now, let us understand that while my portfolio is performing and I'm actually quite happy about looking at the results, I see that over a period of time, my allocation, which was supposed to be a 60,000 and 40,000 or 60-40, has actually changed over a period of time. I see that the 60% and 40% allocation has been maintained. But over the years, as the price of SPY has risen significantly and my number of units have not actually changed, I see a rise in the SPY, not just in terms of value, but also in the percentage allocation it has inside my portfolio. So from my 60% portfolio with SPY and 40% portfolio with TLT has changed at the end of this period to 82% and 18%. Now this change is called the allocation drift. Now why am I talking about allocation drift? Because I have ultimately achieved superior returns. But the thing is, achieving returns is not the only objective. The objective of a portfolio manager is to maintain the portfolio risk objectives and the portfolio diversification objectives. Here, initially, my portfolio was diversified between 60% and 40%. And now the diversification is not so much because my portfolio is highly weighted to SPY. Now you can see this graph representing the same thing. Moving forward, we are going to take this up in Python and eventually come to an understanding that how this drift behaves on day-to-day basis. I'm going to visualize it even on weekly basis. So let us get to it. So as a very first step, I import my necessary libraries. So the first step is to import the required libraries. There we go. And then we define the period and the ticker list. So I have a list of tickers, SPY and TLT, and then the start date being 2019, 1st of January. From there, I take the end of this period. Whenever I'm running this code, the end date is that date. Okay. So this is something I have stored as variables. And there's a little bit of a trivia about the SPY and TLT, which you can pause and read for your knowledge. Then we move on to downloading the data. I use the Y Finance API, and using yf.download, I am downloading the close prices, and I just check my df.head, which is my data frame with all the required data. Moving on, I set certain important variables, and that is firstly the initial weights. Now, initial weights are also going to be loosely called by me the target weights. You have to understand that the 0.6 and 0.4 ratio of this allocation is my portfolio objective. Now, in another case scenario with a multi-asset portfolio or a multi-stock portfolio with a number of stocks, my allocation would have certain weightages which are specified by my portfolio objective. And why we're doing all this is to understand this deeply and how rebalancing is going to get me back to my portfolio objective. So this is important. The initial weights, and these also act as my desired weights or my target weights. Now, the initial capital I see over here, I have stored as 100,000. So this will be $100,000. And the step we're going to do next is something very basic. We're going to assume that there is no rebalancing and the number of shares are the same, like we saw in Excel. What happens if the number of shares are the same? And we're going to encode this on Python. Now, because the number of shares are the same, I take the relative price change from the very first or the initial price. So at the very beginning, my price is going to be exactly like this. And the change relative to the first row or the very initial prices is something I'm interested in. So what I do is I compute this relative change and I store it in price underscore relative. df.ilog0 would actually refer to the very first row as I spoke. Moving on, I need to calculate the position values. So the relative price change from the initial value multiplied by my initial weights. Now these weights are not changing. I'm keeping the weights as 60 and 40. But what is changing is my relative change from the initial value. So I finally calculate the portfolio value by summing it all up and I reach to my PM underscore TF. Now this is going to show me my portfolio value over a period of time, my SPY weight and my TLT weight. So as you can see at the very beginning, my SPY weight is 0.6 and TLT is 0.4. And as we go ahead, this changes on daily basis. Am I going to change anything to the portfolio over here? No. Here we are taking a portfolio where I'm actually not rebalancing. And just to give you an idea how PF underscore DF is going to look like, absolutely in the end, we are going to do PF underscore DF dot tail and we're going to see how the SPY and TLT weight look absolutely at the end of the period. So at the end of the period, I see that the SPY weight is 0.82 and the TLT weight is 0.17. So this is the drift which is clearly visible, which started from 0.6 and 0.4 has now become 0.82 and 0.17, something which we already saw in Excel. Now let us visualize this drift by creating a plot of these returns. So what I have done is, in order to see such a long period of time, I have converted the returns from daily to actually weekly by resampling my data. And in this plot, you can very clearly see how my portfolio value has been rising overall in the period of time. But in the plot over here, which represents portfolio allocation, we can clearly see the SPY represented by the color blue and TLT represented by the color orange. And these bars which are there over here, very close to each other, so it almost looks like it's completely filled, but these bars represent what the drift looks like. So at the very beginning, we started with zero point 0.6 and zero point 0.4. So at zero point 0.6, you can see the blue lines end over here, which says that SPY actually had 60% allocation and was very close to that. But as time went ahead, this allocation changed. Now what we can do in order to see it more clearly is I can zoom into this particular bar and show you
And
what I mean. So this zero point 0.6 is no longer zero point 0.6. SPY actually is over here, you can clearly see 0.8 and TLT is 0.19. So 0.81 and 0.19 roughly. So this is how it actually changes. We can clearly see the drift. Now, if I see this drift on a yearly basis, I will get a better understanding as to how at the end of every year we had said. Now, if I want to see this drift at the end of every year, I'm going to create another plot, and this plot is going to show me a bar plot with my portfolio allocations. So this zero point 0.6 is where the dotted line is, just to show to me what my should be allocation or my initial weights were. So zero point 0.6 should be the allocation given to SPY, and we can see that by the end of 2019, it is not the case. The allocation has actually drifted and it has become a little higher. And by the end of this period, in this mid of 2025, I can clearly see that there's a super high allocation to SPY, which is far away from zero point 0.6. Now, moving on, what we're going to do is we're going to understand what would happen if I was actually going to rebalance this portfolio. And in order to rebalance the portfolio, Pythonically speaking, I need to take some very important steps. The first one being to define the rebalance frequency. Now, what happens is portfolio managers want to rebalance the portfolio so that they can reallocate the portfolio exposure, which represents the portfolio objective. By that I mean reallocate the exposure using our initial weights. But how frequently am I going to do that? Am I going to do that at the end of every month? Am I going to do that at the end of every year? Or am I going to do that at the end of every quarter? So the rebalancing frequency is something which needs to be defined. Here, the rebalancing frequency I have taken is YE, which represents the year end. So at the end of every year, I'm going to be reallocating my exposure in such a way that zero point 0.6 and zero point 0.4, my initial weights are maintained. So once I have actually defined the rebalancing frequency, I need to get some sort of a series, some sort of a list, some sort of a data structure that is going to actually store all these various dates. So rebalance dates have been stored over here. So let me just run this. Now rebalance dates, actually printing it out looks like this. So this is basically the datetime index, and this datetime format represents the dates on which I have decided to rebalance. And this just to quickly show you that if I change this YE to QE, what happens is my rebalance dates become at the end of every quarter. So maintaining it at YE, we take this example forward and we see how we actually use these dates to rebalance. So in my Python code, I first create some variables to store my portfolio value, my total portfolio value as it changes. Now once I have created this variable, I also need to make a note of my allocation history. Now in the previous case, it was quite easy, but now it is a bit tricky. What I need to do is I need to not see this entire data set in its entirety. This entire time period, I need to break it down into several pieces. So this entire time period is going to be broken down from a certain start date to a certain end date. And all this is going to be happening between these rebalancing periods. So let's say I started with a rebalance. I rebalance my portfolio today. Now, the impact of that rebalance is going to happen from tomorrow. And when it is going to happen till is decided by when I'm next rebalancing my portfolio. So as per this example, today I rebalance this portfolio and today is the end of a certain year. The end of the next year is going to be my next rebalancing date. So using this for loop and using my rebalance dates, I'm going to break this start date and end date down into these different several pieces, and I'm going to use the same calculations which I did earlier. Here I'm using df.log for the start date to end date ranges and storing all the prices during the period. Using these period underscore prices, I compute the relative returns. And I use .ilog0 as I did in my initial example. And I finally calculate the position values by multiplying these relative returns by the current values and by the weights. Now, when this is done for one particular range of time, I'm going to culminate this with the other ranges of time and put together, I reach to my overall allocation history as well as my portfolio value as it would have been if I had rebalanced at the end of every year. So here I'm going to run this code, and in the end I get my rebalanced underscore pf underscore df, and here we go. And here what I see is the different rebalance periods which have been printed out, because inside my for loop I actually used for I in range len rebalance dates, and when I define the start date and end date, I printed it out. This I did to visualize if I'm doing things extremely clearly. And to my understanding, we can clearly see that these different periods have been defined very clearly. Now moving on, I check how my rebalance underscore pf underscore df looks like. And it looks like this. From the very beginning, I have got zero point 0.6 and zero point 0.4 allocation. In the beginning days, it obviously doesn't deviate much, but we see how it will perform over a period of time. So what we're going to do is we're going to create a bar plot to visualize these weights at the end of every year for the rebalanced portfolio. So this is a similar bar graph which we had plotted for the non-rebalanced portfolio. And here we see that there is a drift, but that drift is not super significant. For example, the drift which went all the way up to 80% plus of it being completely SPY weight, that is not so much over here. That kind of drift is not something I see over here. So what exactly do I see? When I see that over a period of time, and again I have resampled it to weekly for the visual clarity, I see this is how the weights behave and this is how the portfolio. So the portfolio is obviously in an overall uptrend, and that way it looks nice. But if you clearly look at this portfolio allocation subplot, you will notice that there's something like this little cut over here, a sudden fall over here. Now, let me take you to this area where you see this vertical fall of these blue bars. Okay, so when you see these blue and orange bars stacked upon one another, the blue one is representing SPY. I have marked 0.6 over here to just prompt where our target portfolio is. And I'm going to just zoom in over here, and you will now be able to see what exactly is happening in this area. Now, in this area, as we traverse from December 2021 and go to January 2022, we can see that the portfolio rebalancing has taken place, which is why now my particular allocation is back to 0.6. So you can clearly see this is 0.5975. The reason you don't see exactly 0.6 is because I have resampled this data into weekly. There is a very small drift as this is taking the end of the week data. However, this rebalancing is very clearly visible over here. If I go closely, you can see how suddenly this fall has happened. And this is at the end of the year. Now, coming back to my overall portfolio performance, this portfolio performance by and large doesn't look that bad, and this also doesn't look very different. So, what is different? What is actually going to define that rebalancing is important? So, what is different actually? We need to compare these two portfolios and actually understand why these two things are different. But before I get into comparing these two portfolios, let me give you a slight idea about the most important part of rebalancing. I did mention that we need to maintain our portfolio objective. So, if a portfolio manager decides that these are the assets I'm going to invest in and these are the allocation I'm going to use, the portfolio manager would want to maintain that allocation, and it obviously depends on the rebalance frequency. Now, this rebalancing has some transaction cost, and this transaction cost, when added, also has an impact on the rebalanced portfolio. But then, why do managers still want to rebalance? Now, if you look at these two graphs, you can see that the orange line is the portfolio where there has been no rebalancing, and this blue line, which the portfolio have actually got rebalanced. So, upon looking closely, although you see that the orange line has actually behaved in a way that it is going to give us more returns, the argument could easily be that more, why don't you just not rebalance the portfolio? Just leave it like that. But suppose you are an investor in a fund and the portfolio manager claims to follow a system, claims to follow a method, claims to follow certain rules, and your objectives are obviously associated with the portfolio weights given to every asset. You go and look at the historical performance of these portfolios. So when you look at the rebalanced portfolio, it gives you an actual understanding of the fact you could have been an investor at any of these points in time, and you could have allocated your money according to the portfolio objective. Let us understand this a bit closely. So if I take this entire area, at this point where the orange line and blue line are very close to each other, as a portfolio manager trying to solicit your money to actually invest in this particular fund, let us suppose I show you the without rebalancing graph. If I show you the without rebalancing data, you would actually be quite impressed by the superior returns. But in reality, while your allocations would be close to zero point 0.6 and zero point 0.4 over here, what would happen is that if you were an investor at this point in time, your allocations would actually be different from the objective of the portfolio. So when portfolio managers are actually rebalancing the portfolio, it is obviously to maintain the objective of the portfolio. But as an investor, when you're looking at the historical returns, you're looking at the performance of the net asset value of a fund or a mutual fund for that matter, when you're looking at that, you want to look at something which is rebalanced, because that will tell you that no matter which point in time you put your money, either it is very close to the target allocation or in a certain period of time it will be rebalanced to the allocation, and therefore your actual NAV will be maintained according to the portfolio objective and according to this blue line where we are actually rebalancing this portfolio. So this example was an example of a 60-40 traditional portfolio between equity and bonds. But in reality, you could have many different kinds of portfolios. There could be a variety of styles in which investment is done. And we see in real world that index gets rebalanced. Broad indices get rebalanced once or twice in a particular year. And portfolio managers who manage funds for other people rebalance their portfolio sometimes even once a month. So, if you look at the overall comparative performance of these two portfolios and you check out the metrics, we can clearly see that in this particular case, without rebalancing, we had a slightly higher annualized returns. but it also came with a slightly higher annualized volatility. Now, over here, the difference between the annualized volatility of these two portfolios goes to show that with rebalancing, my portfolio became less volatile. And if it became less volatile, it has reduced my risk to some extent. In this case, we see that there's a slightly higher drawdown with the rebalanced portfolio. And you might be wondering why there's a higher drawdown. So let us take this interesting example again. And suppose we go to this period of 2020 where the 2020 COVID crisis happened and we see how the portfolios are behaving. Now you may be wondering if there has been such a sharp fall, a rebalanced portfolio should have done well because we will not be so much allocated to equity. But that is not the truth. The truth is that during that period of time, all asset classes became highly correlated to each other and even bonds fell significantly, which is why both our rebalanced and non-rebalanced portfolio is showing us a significant fall. Now, I did this entire exercise using four different stocks, and these four stocks were stocks which were not correlated with each other, and these stocks are represented by the tickers over here. Since these stocks were not correlated with each other, they brought a realistic example to the picture where a portfolio manager would actually choose these four stocks and allocate their funds across these four stocks. Now, in this case, I kept it a equal weighted portfolio. That means among these four stocks, the weightages would be 0.25, 0.25, 0.25, and 0.25. We can clearly see over here that in this case, the rebalanced portfolio has actually performed better. Now, why it may have performed better is because in this portfolio of four stocks, maybe some of the stocks have underperformed over a period of time. So that rebalancing has been able to manage the risk and allocate accordingly. So we can clearly see from this example that the rebalanced portfolio has actually performed better. But the main point is the rebalanced portfolio could have outperformed for several reasons. But the most important point is that it stuck to the portfolio objective. This study was done over a similar period of time with a 6 monthly rebalance. I'm not getting into the details of the code. It is something very similar to what we have done. And what I'm going to show you now is the portfolio metrics. So now I'm going to get into the portfolio metrics. Here I can clearly see that the portfolio which has been rebalanced has clearly outperformed. It has given higher annualized returns and it has done so with a slightly lower annualized volatility. The Sharpe ratio of this portfolio is around 0.8, whereas the portfolio without rebalancing is 0.73. This is a significant difference in the Sharpe ratio. So the risk adjusted returns of this portfolio along with the cumulative returns in case of a rebalanced portfolio was high. But the outperformances are not our main goal. The major objective is that if I am an investor who sees this as a historical performance and wants to take a decision on where I want to put my money, then the more valid line to look into is the orange line where I've actually rebalanced the portfolio. And this meets with my portfolio objective, especially on the dates of the rebalance. So after learning what you have learned today, I encourage you to pick up your favorite stock or pick up a set of non-diversified stocks and try and implement this by yourself on Python. See how it works when you rebalance your portfolio and you don't. And the next time you hear in the headlines that this index is going to get rebalanced, or the next time your phone app prompts for you to rebalance your portfolio, now you know why you're doing it. Thank you so much for watching. I'll see you in the next video.